All right. Hello. Good evening, good afternoon, depending on where you are. Good morning, maybe in some places, but welcome to our June LFI monthly meeting. We appreciate everybody attending. This month, we've got a special guest, one of our favorites. Bob has been recently on our podcast, sharing a lot of his information, and he was kind enough to join us tonight to kind of expand on that discussion a little bit or summarize it and then have some Q&A for us. So, but Bob Fraser's here from Aspen Funds. Bob, thank you for coming and being on.
Yeah, pleasure to be here.
Great. A couple quick housekeeping items just to share. Want to call out a couple things going on this week in our event calendar. The Next Gen Investors Group is meeting tomorrow night online. You can go onto our calendar and check that out. We have an Open Tribe deal webinar on Wednesday with Astro Realty Capital. Looking forward to that conversation. And then on Thursday, if you happen to be in the Seattle area, our regional group, the LFI Seattle local team, is going to meet up. And it would be great if you can attend that as well. But a little quieter week compared to last week. And next week's even quieter because of the holidays. But check out the events calendar. The only other thing I'll call out is to remind people to check out the clubs that we have available in our website now. We've started filling these up. That's where the Seattle group is starting to connect. There's actually quite a few regional locations in there now, as well as some interest clubs that you might want to check out and get more ingrained with your fellow like-minded investors. That's the goal of all those anyway, is give you more areas to network with community members. But with that, I will pause and Bob, I'll send it over to you to jump through the material you brought to share with us. But
all right.
Again, thank you for being here.
Yeah, my pleasure.
Great.
Go ahead and share my screen. I'm not going to go through the full presentation here. So I think what we're going to do is just do a few, I'll kind of give some highlights for 10, 15 minutes or so.
Yeah, that'd be great.
And then we'll answer questions. So
yeah,
this is about you guys, listeners, asking questions. So a lot of people have, questions and concerns, and totally get that. So we'll talk about that. So my passion, I started a .com late 90s. Turns out to be a great time to start a .com. If you ever want to start a .com, make sure it was in the 90s, right? Because it didn't matter how crappy your .com was, it went up, right? And it didn't matter how great your .com was in 2000, it went down. And I lost everything in that crash. And I became passionate at that time about understanding the tides, so to speak. Like, hey, the waves, no one knows what's going to happen with the waves, but the tides, you can know what's happening. And when the tides go up, all boats float. And when the tide goes down, all boats sink. And so I became passionate about understanding that. And really, the lesson I learned was that the timing is more important than the pick. And so, and I have many other lessons, including, it matters which horse you ride, and, I actually got $44 million in venture capital, and the venture capitalists taught us that they don't, the idea or the company is secondary to the management and the leadership. They invest in the leadership is really what you want to invest in. So good times to be doing that. It's as there's, not all leadership is the same. Not all jockeys are the same. All right. So the tides. So what are the tides? I became passionate about understanding the tides. And just a little bit about us before I dive into that. 150 million in capital managed, 300 million in assets under management, 10-year track record, and $50 million in distributions. So we're very proud of that. 50 million going back to you guys. So I love it. All right. The stimulus, I'm not going to go in depth, but it was massive and very different. One of the things I pointed out in the podcast that you guys can listen to is that this stimulus was very different than every other stimulus that's ever been done, because it included a new mechanism called debt monetization and also another new mechanism called direct payments to individuals. And it turns out if you wire money to individuals, it's incredibly powerful. So imagine I wired $1 million to every man, woman, and child in America. Well, what happened? Would people quit their jobs? Yeah. Would people invest in crypto? Yeah. Would they take vacations? Yeah. Would they go shopping? Yeah. And that's exactly what we've seen happening. So we've seen a massive, massive consumer boom, and inflation happened. And again, I'm not going to go deep into this slide because I'm just taking just a biggest, shortest overview here. But the early stimulus, so the stimulus on the left here is the great financial crisis. And the stimulus happened at the time when the economy was idle. And if you stimulate when the economy is idle, you create artificial demand at a time when there is no demand or not enough demand. It's not inflationary. The second stimulus during the pandemic, there was 3 of them. And they figured, hey, if it was good in the great financial crisis, it might be 10 times as good this time, right? Of course, that's what politicians do. And well, the last one, Biden's was insane. It was creating artificial demand at a time when our supply chains were already stretched to the limit and people had already exited the workforce. Stupid. I mean, really, we should require politicians to take economics 101, but that's all right. So it's very, very inflationary, and I was predicting inflation at the time. So the stimulus, and the reason I talk about the stimulus is because it's affecting what is happening now. And one of the things that's unique about this time in history, this chart is since 1950, okay? And you can look at the amount of cash. This is checking deposits of individuals and nonprofits. Do you know something about that? It went from basically $1 trillion to $5 trillion overnight. Americans are flipping flush with cash, okay? And what do you do if you're flush with cash? Well, you spend it. And so here we see consumer spending. This is since 2010, the end of the great financial crisis. And look at this uptrend, pretty massive uptrend, increase in consumer spending. This is retail trade. And then stimulus, everyone went berserk and started spending. Anyone got on a plane recently? Anyone been shopping recently? Holy smokes. It's consumer spending. People exited the workforce. This is the percentage of the population that's in the workforce. You see they exited and it hasn't quite come back. Wages have gone up. Consumer, no recession yet. Inflation is cooling, of course. Consumer is very healthy right now. I'm going to hit just a couple things. Savings. You can see right here the savings that boomed during the great financial crisis. I think I can mark this up maybe. No, I can't. Okay, never mind. Well, its savings boomed during the great financial crisis. Delinquency rate dropped. This is the household debt service. It's at an all-time low. In spite of high interest rates, how can debt service be an all-time low? Well, because people are carrying low interest rate debt. And because people saved, they paid off debt during the great financial crisis. Retail or real income is strong. That's even after adjusting for inflation. The wealth effect, which is if the stock market goes up and people's house goes up in value, they feel wealthy. And we're still up 10% since the beginning of the pandemic. So all these things led me to say over a year ago that the Fed is going to have a heck of a time putting us in recession. In fact, I've been reading the Wall Street Journal this morning. It's like people are baffled that they have not been able to create a recession. And I actually said it 18 months ago. The Fed, now they can create a recession. I mean, they keep at this, they're going to create a recession, but they're going to have a hell of a time doing it because the economy is so supercharged right now. And so we're seeing that. Goldman is predicting a soft landing. So have I. I hit a few mega trends. I'm not going to hit these. Demographics are playing a major role in everything. Yeah, I'll hit one of these. Let me see. So here's China. China is in the middle of a demographic tsunami. China, as you know it, is done. It's done. They by this century, the end of the century, their population will be half what it is today. 50% fewer Chinese than today, and 2/3 less workers. Can you imagine China if 2/3 of their workforce evaporated? how are they going to be a manufacturing power? How many more apartment complexes do they need? How many roads? How many iPhones? And it changes everything. I mean, China basically, again, brilliant politicians, this one-child policy, they implemented the one-child policy and had 350 million forced abortions. That's the entire population of the United States. And so they basically got this giant hole in their population. They don't have young people. And young people have babies. Young people want to have babies, and more than that, this may be revelation to some people, but it's young women that have children. And during this one-child policy, they favored men. So not only is there not enough women or not enough young people, there's not enough young women. And the young women that are around, the birth rate of young women in China right now is 1.15 humans per woman. 1.1. It takes 2.1 to maintain a population. They're half that. So China is a disaster. China is going to be a shell of a nation, by the time your children's children are around. So it's over. And China, and what's happening now, and even the world is exiting China. You're seeing a massive reshoring trend. It's actually cheaper to manufacture in America in some cases than it is to manufacture in China. Certainly, if you count the low cost of energy in America, you count any supply chain risk, et cetera. So Europe is not far behind. Unbelievably, the U.S. is actually in a great position. We have a thing called millennials. So we're one of the few nations on the earth that had millennials. I mean, no one else had them. So we're the only guys and the only people in the world that have millennials. So next time you see a millennial, thank them for being around because they are your future. All right. Oh, here's an interesting chart. This is the red line here is the wage in China. It's gone up 15x since 1999. The green one is Mexico. It's far cheaper to manufacture in Mexico right now than in China, just FYI. So as I said, we like to find the mega trends and invest in those trends. The outcomes, the demographics are really, really important. I mean, sometimes you talk about demographics, like the whole you lose the crowd, everybody starts taking a big yawn. It's like we're going to talk about a glacier moving or something, the grass growing, but trust me, they are like glaciers. They're the biggest forces in the planet. They do move slowly, but they also shape everything. So we're going to see continued high wage growth because of fewer workers. We're going to see continued inflation because there's two consumers for every producer. Imagine that, so that just creates pressure on prices. We're going to see higher taxes and pension costs. You're going to see boomer generation retire, which is going to increase capital costs. You're going to see negative GDP growth in many countries in the days to come. Energy, this is my biggest investment opportunity. And it's also one of the trickiest, but it's worth it to figure it out. Energy is there became this narrative in 2014 that the Earth was post fossil fuels, and again, I'm like, what math are you guys looking at? Not real math. I guarantee you that. The world is. Let me see if I have a chart here. I don't think I do actually in this presentation. We're after 40 years or 50 years of trying to decarbonize and get renewables. The Earth, the energy of the world is 83% carbon based. Okay, 83%, 17% is non-carbon, non-fossil fuels. After 50 years of trying, well, and that's great, and everybody wishes it was more, but it just isn't. And what's more, I mean, here's a little stat for you. Everybody says, I mean, I just read a report from the Canadian energy industry, and they're saying that, yeah, we're all post-fossil fuels and fossil fuel demand is going to drop, in the next, few decades because of EVs. I'm like, dude, you have not even read anything. You don't know crap about EVs. Last year, there's 5% of vehicles sold in America were electric vehicles, 5%. And they used up 65% of global lithium production, 65% to make 5% of vehicles. We need 40 times the amount of lithium to just meet basic goals of the EIA. And there's just not enough. And what's more, it takes 8 to 12 years to develop a lithium mine. So if they want that, they better get going. And of course, no one is developing a lithium mine, so you can't get it permitted in America. We have plenty of lithium. But that's just one example. Graphite, cobalt, other minerals are just as rare, and they're just not enough. So the reality is that fossil fuels are going to be around a while. Well, but this narrative came out that we're post-fossil fuels, and this was after this is like the end of the Obama recession. You remember the recession that never quite ended? And so low GDP growth everywhere. So the energy demand was not that high. And so people said, oh, we're now going to see fossil fuel demand going down. But really, if you look at the analysts that really know what they're talking about, no one is saying fossil fuel demand is going down. But what happened is, because of that, and ESG, the environmental, social, and governance movement, began to move capital. They started attacking the capital. John Kerry was running around and making sure that all the big lenders would not lend to fossil fuel projects. And so what happened is all the big institutional money has left the energy space. And it's only the majors, and it's only a few family operators, but the prices have come massively down for oil fields. You can buy oil fields for a flipping song right now. Meanwhile, global energy demand is going to remain. And this little chart shows global energy investment. It's dropped 55% since 2014. Means the amount of money spent to put into develop oil fields has dropped by over half. Again, it's nuts. We're seeing, so right now you see between 5 to 8% per year of existing production drops in oil fields, 5 to 8%. We need 5 million barrels a day of new discovery every year just to replace that. And that takes billions and billions in investment to do that. And if that's not happening, you're seeing a big problem. So we've got two giant forces that are about to collide. And this is Goldman's view. They backed off this $140 a little bit now, but they're basically saying this. Look at this. Supply remains inelastic to higher prices. It means higher prices won't result in more supply. Why? Because there's no more supply to be had. There's not enough developed fields, and they're all running at max. So any kind of GDP growth is going to hit this. So we are backing up the truck and investing in oil right now. And I won't even tell you. Well, maybe I will tell you what the cap rate is. We have a contract out to purchase a producing oil field. This is existing producing oil field, 140 wells for 19% cap rate. Anybody know what a cap rate is? Yeah, insane. And that's getting the proven and undeveloped reserves that are in this, tens of thousands of acres for free. That's how cheap this stuff is right now. And so to me, it's, and that's at $65 oil. What happens if oil goes to double digits, as I believe it is? Well, it's unreal. I won't even tell you what the numbers are, because it's hard to believe. Persistent inflation is going to remain. I've been saying this for well over a year. I said inflation is going to be stubborn. It's not going back to 2%. And the reason is, the supply chain issues are going to be fixed, but energy and workers are not going back to normal. And here's a little chart. This is the CPI, this little chart in the middle. The CPI is the yellow. This is the consumer price index. And look at the price of oil. Do you notice anything? Almost all of the run-up in CPI was due to oil. Almost all the decline in CPI recently is due to oil prices. And this is just a correlation, but it's real. And why is that? Well, because oil is the mother of all commodities. Now, oil is only I can't remember, 7%, and energy is only like 7% of the CPI, but it's underlying everything. I mean, if you're going to do a wheat field, right, you're going to plant it. You're going to use oil, planters and oil harvesters. The grocery industry use ships with diesel fuel. Everything is uses energy, absolutely everything. And so it's way more important than people think it is. And so there's just an example. I just thought I'm going to put, check the correlation. Well, sure enough, it's correlated like crazy. And so here's the bottom line: is inflation is going to be very difficult to contain with any moderate GDP growth. So we have supply issues in workers and we have supply issues in energy, and inflation's not going to go back to where it was. So inflation is our friend or our enemy, right? It's one of the greatest wealth destroyers and wealth creators. And just FYI, at 8% inflation, the value, the price of things doubles every 10 years. That includes your apartment complexes, right? And your houses. Just 10 years, it doubles at 8%. And at 4% inflation, which is what we're at now, it doubles in 20 years. So this is your best friend. You just have to get things that appreciate. And by the way, it depreciates the dollars that you have, including the dollars you owe. So you get a double whammy if you're smart with your debt. And the inflation will pay off your debt, and they'll also accelerate your properties. So what the federal government knows. This is why the U.S. government has never defaulted, and why most nations do not default on their debt. It's very easy just to inflate it away. So inflation is a massive transfer of wealth from savers to borrowers. And who's the biggest borrower around? Well, U.S. government. So best investments in inflation, I'm not going to hit that. Declining interest rates, 40 years of declining interest rates. This is the 1980s. Again, you're going to see interest rates not coming back into the 2 or 3% range for a number of reasons. Primary, a lot of it is demographic, and some of it's inflation. One of the big things we're seeing, and this is what I'm watching very carefully, we're seeing a lot of distress in the commercial real estate market, which I love. I mean, we're very excited about this. There's a lot of deals that shouldn't have been done. There's a lot of very inexperienced underwriters and inexperienced investors that did deals that shouldn't have been done. And all you got to do seems like put a pro forma together, stretch your numbers a little bit, lever up a lot. I mean, I saw deals being done for 2.5% cap rate apartments in Dallas at 90% leverage. So they would put on debt at 80% using bridge debt with a variable interest rate. And then they would add 10% private equity on there. And then they would go raise and put in returns like, we're showing 25% returns. Yeah, great. At a 90% leverage, why don't I go up to 99 and show, 75% returns? It's ridiculous. So we're seeing a lot of deals that shouldn't have been done. This is from Fitch, who rates CMBS. They said 23% of the loans that are maturing in 2023 will not be able to qualify for refinance because of low debt service coverage ratios or low LTVs, meaning the cash flows from the property won't pay the debt, and the high LTVs, the loan to value ratios, are too high. And 23% maturities are going to face plant. According to TREP, we're seeing 270 billion in 2023 maturities and 1.5 trillion in the next 3 years. And they're according to them, 88 billion in securitized mortgages are at risk, 42% of which are apartments. So we're very excited about this. We think we're going to be able to be in a nice little buying spree, in the next 2 or 3 years. It does mean there's going to be a lot of investors are going to get wiped out and doing deals that they shouldn't have been done. But I will point out, in Aspen, we have, I think, 3 multifamily deals. They're all great and it's doing super, but we didn't use any of that. We didn't use any bridge debt. We used fixed rate, traditional debt from banks, and we didn't overlever. And the inflation is awesome. We're already getting rent. So, hey, it's just, you just got to mind your P's and your Q's. We're also seeing huge opportunities for, so a lot of real estate's very healthy. We're seeing less than a 2% vacancy rate in industrial right now, big box industrial, where the big manufacturers and distribution centers are going. That's just on fire still. And we're seeing a lot of developers pulling back, but demand is not pulling back. So we think huge opportunity there. Anybody with office buildings are going to be in trouble. Offices is a big problem. Hospitality is a problem in some locales. And it's going to hit the small banks worse than the big banks. We're not going to see this become a great financial crisis. The great financial crisis happened because the housing crisis became a banking crisis. And when banks fail, that's when you have really big problems, when your plumbing stops working, right? For the entire world, right? The financial plumbing. And that's what was happening in the great financial crisis. We're not going to see that this time. We might see a few banks fail, not that many. Most of the banks any failing ones are going to get snapped up real quick, and they're the smaller, more regional banks. And the big boys are certainly not in trouble. And the banks are very much healthier than they were, 15, 20 years ago, meaning they just have lots of capital and, they're not over levered. So not too concerned about it. Number one opportunity is oil and gas. I mean, this is Warren Buffett's best investment, which should tell you something, right? His number one investment right now. Industrial, a huge need for industrial space. This is the number of jobs being reshored to America. People are coming back to America. The world is over globalized, and now it's deglobalizing for good reason. So our biggest opportunity is industrial. We tried to buy industrial. There's nothing to buy. And so we realized to build it, it's like, this is the way to go. We're just finishing up a building in Wichita, 350,000 square feet, very large industrial park. It's costing us $65 a square foot, all in land cost, building cost, everything $65 a square foot. Right now it's worth about double that. And we're just going to keep doing that. We love industrial. Housing is going to continue to go. What's interesting about housing, there's still a massive shortage of housing. And even right now, you're seeing in some markets, the single family homes are all of a sudden hitting new highs again, even with interest rates, as high as they are. And the issue is there's just not enough housing. There is still a housing shortage. There's a lot of family formation because of these millennials and others. And there's just not enough housing. So I see this big crunch we're having in commercial and multifamily being a great opportunity to buy, because the long-term trend is great. So when you have a short-term counter trend move in the opposite direction of a big long-term trend, that's called buying opportunity. So we love it. Commercial real estate development, we think it's cheaper to build right now than to buy. We're building multifamily. We're building multifamily in Northwest Arkansas, which is the number one housing market in America, Walmart headquarters. And we're building at around 135 a unit that are worth 190 when we finish. So, we love all things like that. All right. That's it. A little plug for my podcast, Invest Like a Billionaire, where we train people how to get out of the public markets into private markets. All right. That's it. That was kind of a mind melt, brain there. Sorry about that.
No, it's awesome stuff. You always,
maybe that'll spark some conversations and some questions, right?
Absolutely. Hopefully so. I imagine we will. Yeah. So please, if people do have questions, drop them in the Q&A, and we'll be happy to run those by Bob and see what kind of feedback he's got for us. But no, always really interesting to see the information you've dug up and you're basing Aspen decisions off of and everything else. Really quality stuff that I always really get a kick out of seeing what you've dug into, by all means. I always like to relate these things back to the limited partner, which is what our community is, and all the like-minded folks. How can us as limited partners kind of implement strategies off of a lot of these decisions? I think maybe it really falls on your opportunity slide there at the end, but I think of China and all the stats you have on China, the long-term effects they have. What can we do today to build up our legacy that helps our children and everything else like that from a limited partner standpoint? That's a big question to throw at you, Bob, but I'm going to start with that one.
Yeah. Well, talk to your millennials and make sure they're having kids, America is actually in great shape, and we have a lot of hope. And I think that is one of the reasons why we have a growing population. And, we just hope our leaders can continue to make good decisions and like that. But as far as opportunities, the number one place I'm investing is in the reshoring of America, and that's a bet on deglobalization and a bet on the change in China. And so that's the number one, and in all things America, really. I mean, this is the top. You're lucky to be in the top investment destination in the world. And if you were an investor in China, well, what are you going to do? Very, very challenging. You got to try and get your money out of China. But we're sitting great, and there's lots of opportunities. I mean, I've given you some of the best ones that I'm aware of.
Well, and I like the industrial trends that you're talking about. That seems like a really good place to be looking. That if the U.S. is bringing in, I really like this chart of how much is coming back into the U.S.
Right.
Then great value in that space to look for it, especially Aspen. If they were developing, that's fantastic.
Yeah, we like the real estate plays, but there's a lot of ways to play this. I mean, go start supplying anything as a manufacturer. Go buy manufacturing businesses, build manufacturing businesses. There's a lot. By the way, do you know what the natural gas prices are in Europe right now? They're about $7.50. Do you know what it is in America? $2.50.
Oh, wow.
We have the cheapest energy in the world. People don't realize America is the world's largest oil producer, number one. If you want energy security, there's only one nation in the world. If you want energy security and you want an industrial power manufacturing power, there's only one nation that qualifies, and that's America. We're the only nation that's an industrial power and a manufacturing power that has ready access to energy without having to go anywhere.
Interesting. No, that's good stuff. Again, just a quick reminder, drop any questions you have in the Q&A. We'll be happy to run those by Bob. On your multifamily slide, I really like that last one that you had that showed the difference of mortgage price versus rental price. To me, that gap that's there, that tells me there's a lot of room to still do improvements, raise rents, that rents are still going to go up at a decent pace.
There is.
That there's a lot of potential because people are starting to say multifamily is cooling off. That feels to me like, no, there's still a lot of good room to improve there. There's still a healthy gap.
It's not. And what this shows is that whenever home prices rise, you see that cool off, and the issue is both are going up. And so one of the points you could draw from this is invest in housing, whether it's single family or multifamily. Just get into housing, and whichever gives you the better value. And that's really what young people are doing when they're looking for housing. People need a place to live, and there's just not enough. We have a shortage of millions of units, depending on who you ask. I've seen numbers as high as 17 million units in shortage. So it's a great opportunity. And, unfortunately right now we have a counter trend move where you're seeing the prices of multifamily is dropping. You're going to see cap rates going up. But that's called buying opportunity. Not good for people who have already placed their capital. But for us, it's like prices are going down. Oh, great. We're still going to hold, and we're going to wait for prices to recover. As long as you got cash flows, right? And as long as you're meeting your pro formas and your income is going up, it's great. And our apartments right now, we're meeting our 5-year pro forma rents right now that we were expected to meet 4 years from now. We're meeting now.
That's great.
Yeah, we're meeting now.
Well, to me, this speaks to a few things. One, this is why we preach get involved with the community, so you can get into this education and share this information from others and get yourself prepared. But it also speaks to diversity, because in this economy, in the state that we're in, you've spoken about how there's going to be 23% that are going to default. There's going to be, a lot of people caught, a lot of investors caught in situations that hopefully you diversify, that you won't take a hit in your whole portfolio, because coming out of this, it seems in the next year or two, there's going to be a whole lot of really good opportunities.
Totally.
That you can catch the upswing, but always hate to catch the falling knife, but there's going to be better times coming soon. It seems like too.
Right. It's time. I think it's time right now. I think that we've seen the bottom in single family homes. I think we've not seen the bottom in multifamily, but we'll see it in the next 18 months or so, probably. But there's a lot of operators like that are doing just fine in their commercial portfolios. It's, what happened is there's kind of a syndicator bubble. A lot of young syndicators got on the, hey, how to syndicate a real estate deal webinars, and figured out how to raise capital but they did deals that shouldn't have been done. They over-levered, they overpaid, and those are the deals that are in trouble. And So
But as an LP investor, the benefit I see in all of that is my filter was really large of how many operators
right
there were out there. It's shrinking. It's going to be better
there you
to
go.
find the ones that know what they're doing and everything else. So
That's right. And whatever they claim to be, whatever you claim to be the IRR at the end or the multiple, that's not the main number you want to look at. Okay. You want to look at the debt stack and you want to understand the risk.
That's where, I really got into this about 4 years ago. I could get away with getting, excited about the IRR and the multiplier, and that would be
Right.
enough. I've learned very quickly that, there are a lot more important numbers in there than those numbers for sure. But
Right.
we did have a question come in from Kevin. It says, when you're referring to the returns you can get today investing in oil, were you referring to non-operating working interests or mineral rights?
Non-operating working interest. So we're buying the leases. And the field we're buying is operated by all majors. And 19 cap rate, which means it's going to, for those of you that are not versed with cap rates, that means it's a 19% cash on cash return, which is insane on existing cash flows. These are in place producing cash flows from 140 wells. So what's the risk there? Really, the risk is you got some depletion and then you got the price of oil, and that's about it. I'm happy to take those risks.
Yeah. Well, and it seems like it's a different ballgame in oil and gas these days too, because you said on the podcast, they know right where it is. They've gotten so precise about where to find this now that you aren't going to run into the dry well situations as much.
No, these basins are very well understood. I mean, they've been developed for now 20 years, and they're extremely well understood by what's going on under the ground. And there's really, you can't say there's no dry holes, but it's very, very rare. And so this field we're buying has about 80 wells, developable wells that it has proven undeveloped. Means proven, it's mathematically proven. That's actually an SEC designation. Means it's guaranteed to be there, 95% probability. And that's all free. And so we're going to develop those. The economics of a new well is about 50% returns. So IRR basis for the first, 3 to 4 years. And so then we just drill and the numbers go nutty. And that's if oil stays flat and doesn't do anything. That's what I like. I like to find deals that, hey, if I'm wrong, I'm going to make a lot of money. And if I'm right, I'm going to make insane money, right? That's the kind of deals you want to make, right? Where the tides, I not only did a good deal, but I got the tides as well.
No, that's fantastic. Julie asked, I should have hit you up on this when the question came up, but can you elaborate on what is non-operating working interest in those situations?
Okay, so a working interest is when you own the rights to the profits of a well. Okay, so we buy the leases from the landowners, right? We buy the leases and we own those leases. And then we basically we participate in the profits of those wells, but we don't operate. So we have we have about 8 operators. Most of them are public companies, billion-dollar companies, Marathon, Devon, big guys. So non-operating means we do not operate. So they operate. So, but we participate. So if we agreed to take, we'll take 20% of that well, and Marathon will take 80% of that well. So we split the profits 20-80. You follow me? But we also split the cost 28. So if they decide to rehab the well or it costs money to this or that, we pay 20% of that. That's what that means.
Gotcha. Thank you for that, Bob. That helps. Chris asked, related to the oil scenario as well, how often will you be distributing cash in those? He's got a few questions, but I'll pause there. You can talk through.
You're talking about our fund in particular?
Your fund, I'm guessing, is what Chris is.
We're just launching it next week, but that fund we're going to not distribute for the first year. And then after that, we're going to take about 50% of the profits and distribute it. And we're going to take 50% of it and drill. So it's going to be a cash cow.
Gotcha. What's your distribution rate? Is it going to be monthly, quarterly?
It'll be quarterly.
Quarterly there. And then he asked, how long will will the hold be for that for your oil and
That
gas?
is 10 years. So,
Okay.
but it's so stinking rich, why would you want to, you're getting this massive check. Who wants to let it go?
Right.
So,
Then he,
and we don't know what we're going to do. I mean, if oil does spike to, $150, $190 a barrel and prices of these things recover like crazy, we might sell it. I'm happy to sell it. So I'm a financial investor first.
you've got that flexibility. Yeah.
But if it's at this rate, when it's cash flowing as much as it is, you just want to milk, the price to sell it is not worth selling it. It's better to milk it.
Yeah.
Right. You want to, your milk cow is, the price of the cow is nothing and the price of the milk is everything. Well, what do you want to do? You want to milk the cow. So that's what we're going to do. We're going to milk the cow. We're not going to sell the cow.
Yeah, it's multiple exit strategies you have there.
Right.
So it just
exactly.
depends. Yeah.
Or no exit. You got
that's true.
Cash cow, just hold it and give it to your kids,
Yeah. And that kind of relates to his next question, I guess. It says, will the asset be appreciating over time, even with the depletion because of the increase in price of oil? All of that, I assume, factors into the value you got there.
It does. It does. And generally you see oil fields. We got about 80 spots we can drill. So in 10 years from now, we'll probably have drilled most of those. And it should be actually worth more today than it is, more than it is today. But who knows? I mean, because they've spent so much energy, the ESG movement. I mean, today, if you're a fossil fuel producer, you got to put a bag over your head, paper bag over your head, right? Well, that's when you want to be investing. When you got to put a paper bag over your head, and when you're boasting to your Uber driver about your investments, that's when you want to be selling, right?
Be leery.
So this is the paper bag investment, and but the prices have just plummeted. This stuff, these producing oil wells are selling for a song, and who wants a dead industry? That's so the institutions believe, and everyone's trying to get their ESG scores up. No one wants to own a well. Well, I'm happy to. I'm happy to get my little fingers dirty. Right. And own an oil well, and I'll even skip the paper bag.
Well, you'll have to hand that to people that passed out sometime, I guess, down the road. So the next one was related as well to the same space. Do you have any future exploration rights in these leases that you're referring to?
Yeah. The leases means we own. We can do any amount of drilling we want on the land, and so that's absolutely, that's all there included. As long as the only way you lose a lease in the way these leases are structured is if you don't produce. And so, but if these things are producing, which they are, then the lease is valid, and it has no expiration as long as it's held by production. So so we do. And this is just our first acquisition. We're doing a $50 million fund. So this will be the first one. That's about a $30 million purchase. We want to go out and buy, one or two more purchases. So this is just an example of the first one we're buying. We're under contract.
Have you guys partnered with any experts in the area? Like, where did you get your knowledge then? You've partnered up with people to help kind of decide what Aspen's going to get involved in.
Yeah, we've partnered with a firm in the Midwest called Mahajer Energy Advisors, and they've been around 40 years. This is their 6th fund that they've done. Not a fund they've ever done has done less than 30% IRR. Okay.
Wow. And
that includes in the 90s and the 80s when things were not what they are now. I mean, the good times and bad times. These guys they're an energy, geology, analytics, and engineering firm and finance firm. So these are the guys that have run the models for all the big private equity firms for the last 40 years. So they're the ones that do the energy analysis, and they're partnered with us. They love us, and they've always raised with institutional capital. And they're like, gosh, we just love to raise for the normal kind of folks. And we'd like to serve those guys here. And we'd love to find a group that will do that with us. And so we partnered with them, and they're incredible, great people. I mean, salt of the earth. They're engineers and geologists. Okay. But they really know their stuff. And, this is.
What's the fund starting to structure as, like, percentage mix of? You've got multifamily development you're talking about. You've got the oil and gas you're talking about. You've got industrial that you're talking about. Can you speak to how you guys are kind of deploying your strategy for those different areas and how that looks from a limited partner standpoint?
Now, for us, everything we do is a separate fund. So the oil and gas fund is its own deal. That's all it's going to do is oil and gas, right? So it's this field plus we'll buy a couple more. Every deal we do, we did 12 placements last year. We'll probably do about 12 this year. And every one is a separate deal. So we don't have funds, so to speak, of multi, it's generally 1 or 2 or 3 assets in a fund that becomes an LLC, and we invite limiteds in there. So right now, my number one investment personally, and by the way, one of the things that make Aspen unique, I mean, the founders of Aspen, we're created Aspen for our own capital. This is where we're deploying our own capital. So every deal I invest in the same terms as my limited partners. And I just exactly the same. So my personal capital, my number one investment is energy. My number 2 investment is industrial. And my number 3 is multifamily. We're also going to be looking at starting a distressed debt fund maybe this year, maybe next. To do the distressed commercial bailout funds. So we'll basically, help the operators that got overwhelmed with doing rescue capital deals, and you can make outsized returns. We've been offered a deal that we make a 50% return, but it's tricky enough that I just we're going to take another look at it, and we're going to, that kind of thing. But yeah,
it might get quite popular here.
Oh, it will. It will.
At least 23% of the population.
They're begging. I mean, $2 million saves a $25 million asset. They just need 2 million. And they're willing to give up all the general partnership. They're willing to subordinate. The private equity will subordinate. It's incredible deal, but tricky enough that, I want to, I'm not going to rush into it. I'm going to make sure I have a strategy. And so we passed, but there's a lot of these deals coming. Yeah,
no, I think that's fantastic. Any other questions out there? Any topics we jumped to? Oh, here's one popped in. Says, since you plan on holding these leases in a fund, will individual investors still be able to claim intangible drilling costs as well as depletion?
Yeah.
Awesome.
Yeah. We have
that a little bit.
Cracked the code on that. So we have figured out how to do it. It's so stinking cool. So you can actually, so that guy, whoever asked that question knows there's incredible tax bennies. So you guys have probably done a lot of real estate, and there's great tax benefits there. Well, oil and gas puts it to shame. I mean, depreciation you have to recapture in real estate. In oil and gas, you don't have to recapture intangible drilling costs. You don't ever recapture it, and you get a 15% pass. You only pay taxes on 85% of the production to account for depletion. So, and we do pass that to limiteds. And here's the kicker: if you elect to, you can take any losses generated, there will be losses as we start drilling right away. You can take that against active income, literally W-2 income. So crazy if you're a doctor, lawyer, or whatever. Yeah, you can get a tax deduction, and while you're cashing the checks, it's just, oil. It's a unique business. It's nothing like it.
It is. It seems to have a great cloud. I mean, there's been a stigma with a lot of operators and so forth.
There is.
So I think there's a lot of people that are scared to get back into it, aren't trusting that there are tangible benefits there anymore, or trustworthy operators. I guess
that's it. That's it.
The benefits are definitely there. It's the operators.
Yeah. So the institutional capital has fled. There's a lot of big families that are deep in oil and gas, but a lot of the other guys, the little operators, they're just shysters.
Yeah.
And so, but that's the true in anything, and oil is just that much more. But, but when everybody's afraid of something, okay, think about it. That creates scarcity of capital, and it's one of the reasons that driven the price down. So you got to be unafraid when everyone's afraid, and you got to be afraid when everyone else is unafraid. That's the way you make money.
More Buffett conversation there. That's good stuff. Very good. Any other questions? We'll throw it out there. Anything we missed, Bob, that we should have asked you about tonight? Do you think? You've hit on a lot of your hot topics, that's for sure. But
yeah. I think just thinking about this, and we've seen some bad deals coming down the pike, and I got one personal investment I made that is not an Aspen deal. So I've been just placing my capital. It looks like it's in trouble, and so it happens to everybody. That's why you have to, one, diversify, but two, the main thing you want to know is pick your operators. It really is. Pick the right operators, and you can't watch everything at every time, right? You have to trust your operators to be doing that. And that's really the main thing. that you should be learning. And like I said, it's what I learned from the venture capital people. They said, what's the secret? I asked them, what's the secret to successful? This is the most successful venture capitalist in the 80s and 90s. And he said, don't bet on the horse, bet on the jockey.
There you go.
And so there you go.
I agree 100%. We have another one that popped in here. What would be the typical minimums on that oil and gas fund, or just the structure, I guess, for a limited partner? I don't know if you can speak to that a little bit.
I think it's 100. I think it's 100,000.
Okay. Very good. All right. Well, we're getting close to the end of it here, and questions are drying up. If there's any others, reach out. Maybe you can flip back to your contact page again too. And by all means, those that are listening in tonight or that listen to the recording, feel free to reach out to Bob directly or anybody at the Aspen Funds group. There's a good group of people there that we talk to quite a bit and really enjoy speaking with.
Yeah, we love you guys. We have a lot of left fielders in our, and great, passionate people are solid, and we love working with you guys. So,
well, we enjoyed you coming out to the meetup last year. We hope you're able to make it out again this year. So
I missed the coffee cup with the Aspen logo in it, man.
That's right. That's right.
Gosh,
You gotta love those. I don't know if we could pull that off again this year or not, but we'll see. Oh, hey, I'm sorry. Chris threw another one in here real quick. It says, do LPs have to be general partners initially to get the best tax benefits?
Yes, but it's your choice. You choose. So you pick. And if you want the tax benefits and you're willing to be a GP, then do that. If you don't and you're not, then don't. So we've actually structured it so it's a checkbox, whichever you want to do. Gotcha. And perfect. So whatever your appetite is.
Very good. Do you take your risk tolerance into consideration? And,
that's right.
Take your pick. Well, Bob, again, thank you so much for being on tonight. Thank you for all the support you give us as well. We really appreciate that. I think this knowledge is so important for people to get a hold of. So thanks for being on the podcast and sharing a lot more detail. Thanks for coming on tonight and giving us the quick synopsis of everything too. So,
all right, you bet. And, go have a great year, you left fielders.
There you go. There you go. Hopefully we'll see you in October as well. But thanks for being on. Thanks for everybody else that tuned in tonight. We appreciate that as well. We'll talk to you later.
All right.
Bye-bye.